Hi, welcome to the session. This is Leroy Meadows, and today we're going to be talking about job costing, and the focus is going to be determining the cost of jobs completed and uncompleted, calculating account balances at the end of the period, and accounting for overhead. So let's go ahead and get started here. So let's talk about the basics of any costing system. The basics of any costing system, well, we looked at a few of them prior in a previous session where we talked about cost management basics. A cost object is anything for which a measurement of cost is desired. For example, if I'm building a house and I want to know how much my house is going to cost me altogether, then that house would be a cost object because I want to know all the costs associated with it. My cost object could be this can of Mountain Dew. It could be the can of coffee. It can be anything. A cost object can be anything I want. It can even be a department. It can be a plant facility. There really are no limits to what we can use as a cost object. And so a cost object is anything for which a measurement of cost is desired. Direct costs are any costs that can be traced feasibly and economically to a cost object. And what kind of costs are direct costs? Well, we talk about direct materials and direct labor. Those are examples of direct costs, and we trace those costs to a cost object. And then we have indirect costs. Any cost that cannot be traced feasibly and economically to a cost object. So as we're going to learn today, direct costs are traced to a cost object. Indirect costs are going to be allocated to a cost object. And then there's a couple things with allocation of costs. We're going to take a look at what a cost pool is. Now, a cost pool is simply a grouping together of individual indirect costs. We can have one cost pool, we can have multiple cost pools. But a cost pool is just simply a grouping together of individual indirect costs, and we're lumping them together in one pile. And again, we can have more than one pool. We can have two, we can have three, we can have four. But we can have one, but we can have, but that's what a cost pool is. We can have one or multiple cost pools, but it's just a grouping together of individual indirect costs. Then we have a cost allocation base, and that's simply a systematic way of allocating overhead costs to cost objects. So it's taking that cost pool, and it's a system cause and effect relationship, most likely, that we're going to spread out that cost pool or those overhead costs. We're going to spread them out over the different units that we make, but we've got to have some systematic way of doing it. Now, usually there is a cause and effect relationship. For example, if a department or a plant is labor intensive, then we would spread out costs over labor hours or labor costs, because machining is going to be a very small part of it, because the job's labor intensive. However, if the job has very little labor in relation to the amount of machining costs or machine costs or automation or whatever, then we would most likely use that cause and effect relationship over machine hours. The more machine hours we use, the more overhead costs we're going to incur. So it depends on the allocation base. It depends on the setup that we have in our manufacturing facility, or any facility for that matter. Because as we're going to look later, we can actually use the allocation of costs in a service sector. So we don't have to just be talking about manufacturing. We're going to have overhead costs in a service sector. We want to make sure we can allocate that on a cause and effect relationship. Sometimes there's not a clear cause and effect relationship there, so we might allocate it on the benefits received. The department will have the most benefits out of it, the most reward, will bear greater will have a greater share of the overhead costs assigned to it. And then finally, based on the ability to bear costs. Sometimes we'll see this with municipal municipalities. Some sectors of running a city government would be more likely to be able to bear costs than others. So we might see that, but we're going to assume based on what we do in the manufacturing environment or in a service environment, we're usually going to assume that it's going to be based on the cause and effect relationship. So give me just a second here. So we're just going to assume it's going to be based on a cause and effect relationship. That's what we're going to assume unless we're otherwise told. But I did want to let you know that there are other ways of allocating overhead, and that is based on benefits received and on the ability to bear costs. Now, when we look at job costing, that is one of two basic types of costing systems. Job costing is the production of individual or small batches of individual units, where the opposite costing system would be process costing, and that deals with the mass production of identical units. When we think of process costing, we can think of making bottles of ketchup, maybe bottles of iced tea, things like that. Whereas in job costing, we're producing individual or small batches of individual units. In job costing, costs accumulated by jobs, whereas in process costing, we accumulate costs by department or processes. Job costing, resource consumption varies by job. Some jobs will consume more resources than others, whereas in process costing, we're under the premise that resources are going to be consumed equally by all units. There's going to be, in the bottle of ketchup, there's going to be the same amount of tomato, same amount of salt, same amount of everything that goes into making that bottle of ketchup. And in job costing, we'll have one single work in process account. In process costing, we will have multiple work in process accounts. So our focus is going to be on the job costing here because, well, obviously because it's a chapter, but we want to focus on the making of individual or small batches of individual units, and we want to account for those costs. So before we get into here, let me go back here and let me take a look here. We remember from before in our cost basics management, what type of inventory accounts do we have? Well, we have materials. We have materials. And then we have what? Work in process. And we have finished goods. These are the three types of inventory accounts that we have. Now, previously, we've also talked about what types of a costs are going to go into the making of a product, whether it's process costing or job costing. What costs do we have associated with making products? Well, we have direct materials, plus direct labor, and manufacturing overhead. So those are the three costs that go into making of any type of unit, whether it's job costing or process costing. So let's take a look here and let's get some basic things under our belt, some basic concepts under our belt, and then we're going to review these and then see how they play out in job costing. So let's take a look here and let's talk about the concept of control and subsidiary accounts. Now, the control account is the main account that we would expect to see on the balance sheet. Or let's see, on the balance sheet for inventory, or maybe not even on the balance sheet because we don't record labor on the balance sheet. It does show up in whether it's in work in process or finished goods, the cost of labor that's incurred. But labor, we would have one count for labor if we wanted wages payable, but we would pay everybody separate based on their own individual hourly rate and the number of hours they worked. But now let's look at the inventory accounts. Raw materials. What type of raw materials we have? Well, we would have batteries, screen protectors, cameras, processing chips if we're making something. So if we have a materials account, we might have one line item on the balance sheet, but on our books, we would have individual ledgers for all the different types of accounts. Why? Because we want to track the number of batteries that we need or that we have. Why? In case we need to order more batteries. We don't want to just lump everything together and not have some way to account for each one of the inventories. And not just for ordering purposes, but for valuation purposes when we do counts. We want to make sure that we have the appropriate number on hand whenever we do our physical count. So raw materials or materials account, work in process account, we're going to have one line item on the balance sheet. However, that total of work in process on the balance sheet is going to comprise of all the individual jobs that are not yet completed. Remember, the work in process account, if we remember from before, these are units that have been started but not yet completed. The materials account is just the materials that we buy from our suppliers, and we bring them into the storeroom rather, and then as we need them, we transfer them to production floor, and then at that time, we add labor, we add overhead to those units in order to create what we call finished goods. And those finished goods, remember, those are units that have been fully completed and are ready for sale. My finished goods inventory line item on my balance sheet, well, it might have a total dollar amount, but that total dollar amount is going to comprise of the different jobs that are completed and are just waiting to be sold. So now before we talked about, and let me go over here and let me do something. And we talked about before, what are the costs associated with making a product? Well, previously we had talked about what? Direct materials. Let's see. Oops. Plus direct labor. Oops. I just can't get rid of that equal sign. Plus manufacturing overhead. Now, prior to this, we had talked about manufacturing overhead in the sense of the costs incurred. But now we're going to refine our understanding of manufacturing overhead to manufacturing overhead that's been allocated to the product. So now it would be the cost of a unit of output. So unit output is that finished good that we make. Unit's been completed, fully completed, just waiting for sale. And it's going to be comprised of the cost of direct materials, direct labor, and then manufacturing overhead allocated. So how do we allocate manufacturing overhead? Well, in order to allocate overhead, we've got to first find an overhead cost rate. How are we going to decide, based on our allocation base, the amount of overhead a particular job is going to receive? Remember, we talked about that each job is going to consume a different amount of resources. So if it's going to consume a different amount of resources, we've got to find that cause and effect relationship so that a job that consumes more of that allocation base will be assigned more overhead than a job that uses less of that allocation base or less of that cause and effect. So what do we do for that predetermined overhead allocation rate? We simply group together our cost pool. That, remember, we mentioned just a few minutes ago that group of individual overhead costs into that cost pool, and we'll take that cost pool and I'm going to divide it by the estimated amount of the allocation base. Now, we usually do this at the prior to the beginning of the year. If we're going to estimate our overhead costs for the next period, we're pretty knowledgeable, and we're probably going to know what is our allocation base. Like I said, if I'm in a labor-intensive environment, then I'm probably going to take those estimated overhead costs for the next year and divide that by the estimated amount of either direct labor hours or direct labor costs. So I'm going to get an allocation rate here. So my allocation rate is just simply my overhead cost, that overhead cost pool, by the divided by the estimated amount of the allocation base. For example, let's say that next year I expect to have $300,000 of overhead costs. And because my department, my job, my plant is highly automated, a lot of machining, I'm going to assume that my allocation base then, because it's not labor intensive, it's more machine intensive, then I'm going to allocate overhead on the amount of machine hours. So how many machine hours do I expect to use next year? Based on my projections, I might use 4,500,000 labor hour or machine hours. So if I have an overhead allocation rate, what is my allocation rate? Well, my allocation rate is going to be what? 300,000, my expected overhead indirect cost for next year, divided or spread out by 4,500,000 machine hours. So and I have 0.66667. So I'm just going to round that up to 0.067. Or what am I saying with this? What does this mean? Well, what this means is for every machine hour that a job takes, I'm going to assign 6.7 or 0.067 cents of overhead to each job for each machine hour. So let's say, based on this rate, let's say I have a job that takes 2,000 machine hours. Well, how much overhead am I going to assign? Well, my 2,000 machine hours, since I'm using in my illustration here, machine hours, my allocation base. So for the job that consumes 2,000 machine hours, I'm going to multiply that by 0.067, and I'm going to assign overhead costs of, let me calculate it out here, $134. So that job, whatever the direct materials and direct labor is going to have $134 worth of overhead allocated to it. So with job costing, I'm not changing excuse me, the direct materials or direct labor. I'm just looking to how to cost each job, and now I'm refining my manufacturing overhead to manufacturing overhead allocated. So let's take a look here, and let me clear this off here. Now, some companies will only have one overhead cost pool to allocate overhead. Other companies may have departmental cost pools, and we'll see an example of that a little bit later. Another thing I want to talk about the overhead cost rates is when we're estimating our overhead costs, and when we talk about numerator reason and denominator reason, we're talking about the numerator in here in our allocation, in computing our allocation rate. And the denominator reason would be the reason we want to, we're using longer periods of time here. Now, why do we want to use longer periods of time, such as 1 year, when computing overhead allocation rates? Well, if I just compute a new allocation rate on a monthly basis, what could happen? Well, the numerator-wise, for estimated overhead costs, seasonal patterns might have greater influence on the amount of the costs. And for the denominator reason, months with higher fixed costs and lower output will distort the true cost of producing a single unit of output. So if we take our estimated overhead costs and we're looking out for the next year, not just for the next month or next quarter, we look at it, we do an allocation rate that's based for the next year. then what happens is we're smoothing out all those seasonal patterns, and we're smoothing out all those months with higher fixed costs and lower output. So we get the true cost over a full year. We get a better sense of the cost of making a unit um, of output. So let's take a look at overhead cost rates, and let's just look at an example here. Now, the XYZ company provides the following information, and we're asked to compute the predetermined overhead allocation rate for next year. Total manufacturing overhead costs estimated at the beginning of the year, $140,000. Total direct labor costs estimated at the beginning of the year, $320,000. Total direct labor hours estimated at the beginning of the year, 10,000 direct labor hours. And then we're giving our actual overhead costs, actual direct labor costs, and actual direct labor hours. So we're going to look here, and we're going to get, remember we talked about our overhead allocation rate is estimated overhead costs for the next year divided by the estimated amount of the allocation base required. So in this case, we're looking at what? Well, we're looking at total manufacturing overhead costs, $140,000, divided by the estimated direct labor costs for the year, $320,000. So what is my overhead allocation rate? It's going to be 0.4375 or 43.75. So, and that's our allocation rate here. So now let's talk about another concept of actual costing versus normal costing. Now, under actual costing, we wait until the actual amount of overhead costs and allocation bases are incurred and known before computing the overhead allocation rate. In other words, we wait until we know the actual overhead costs so we wait to assign overhead until we actually know the costs associated with that, the actual overhead costs, and the actual amount of the allocation base that we've used. Now, now we talked about pros and cons of this. Pros, well, each job will be costed out accurately. We won't have, we'll have accurate overhead costs assigned to each unit of output. Another thing is we will have no adjusting entry to be made at the end of the period or at the end of the year. So, and we'll talk about adjusting entries for overhead a little bit later. Now, one of the cons is waiting till the end of the year to obtain actual overhead cost and allocation base usage. It doesn't allow management to accurately cost out jobs throughout the period. So corrective action taken in the middle of the period and throughout the period can't be taken. So our profitability measurements will not be as accurate as we go along. So it can negatively affect pricing decisions. For example, if I wait to have my overhead, if I wait to figure out what my actual overhead costs are before I compute the total cost of each job, well, I could shortchange myself as far as recovering the cost by setting a price. When I set a price for something, I want to know all my costs up front. And if I don't know all the costs of selling a product, of making a product in order to sell it, if I don't know all my costs, if I set a sales price, I could price myself out of the market. I could price myself too low. And so I could leave money on the table. Plus, the cost may be actually higher, and I can't make any adjustments throughout the period because I don't have anything to go by. Now, we're going to assume for most situations here, we're talking about normal costing. And what we've talked about up to now is normal costing, where before the beginning of the period, we're going to estimate the amount of overhead costs and then estimate the amount of the allocation base so that we can compute an allocation rate. Now, why would we want to do that? Well, it allows managers to determine the profitability of a job and the efficiency of which jobs are done, and to determine the pricing of other jobs as soon as they're completed. Information is received earlier and corrective action can be taken. For example, if I have my direct labor costs and direct materials cost But under actual costing, I don't know how much overhead I'm going to assign to a product. Well, then it wouldn't. Then my pricing strategy may be off. Under normal costing, if I do have some type of overhead cost assigned to there, my overhead that's allocated to the job may not be completely accurate, but at least I've got a general sense of how much overhead that job is taking. So if I see some variances or see some issues, I can take corrective action earlier instead of having to wait to the end of the year where I can't make any corrective actions. Now, the con of that is estimated and actual overhead costs are going to require an adjusting entry at the end of the period. If I estimate my costs and I go based on that, and then I get my actual numbers at the end of the year, well, there's going to be a mismatch between the overhead allocated and the overhead incurred. So I'm just going to have to adjust to close those out at the end of the year and do an adjusting entry. And another con is that the actual cost could be significantly different from the estimated costs. So now let's talk about the concept of source documents. This is a concept you learned in financial accounting. You've learned in managerial accounting. You've learned in intermediate accounting. And let's just review these. Source documents, what are they? They are documents that prove or something that proves that a transaction occurred. So here's some situation where source documents are needed and what type of source documents are available, especially for us when we're talking about cost accounting. Well, raw materials purchase. What would be some source documents to prove that we purchased raw materials? Well, we would have a purchase order, maybe, a packing slip, an invoice. Putting those three together, we can prove that we not only placed the order, we received the order, and we also have the invoice in order to have to pay it. What about raw materials used? Well, when we take those raw materials or materials from the floor from storage to the work in process to the production floor, and we transfer them to work in process, well, we have a materials requisition. And the materials requisition is just simply anybody that's requesting materials from the storehouse to be transferred to the production floor. What about labor incurred? Well, labor incurred, we would have a labor timesheet. A lot of times labor is incurred through electronic means, through an electronic labor timesheet, but there are also times where we have paper and pen or paper and pencil, and we keep track of the labors on paper for more specific items, and then we have Chronos or some type of automated system for the labor hours incurred throughout the day or what have you. A lot of jobs, a lot of things take paper as well as the electronic part of that. And then also the cost of job 123, what would be a source document for that? Well, the job cost record. The job cost record is simply going to be the tracking of materials transferred to the job, materials requisition to that individual job 123, the labor costs incurred, the direct labor costs incurred for job 123, and the manufacturing overhead that's been allocated to the cost of job 123. So that would be a job cost record, and that would be something like a source document for the cost of that job. So something that proves that a transaction occurred or that something occurred, source documents are important. Now let's talk about cost flow in a job costing system. Now, we talked about before in cost management basics and earlier today in this session, the flow of cost of manufacturing company. We take our materials account. Some people call it raw materials. Our materials account, those are requisitioned and transferred to the production floor. And once they're transferred to the production floor, the cost of those materials is transferred to work in process. Once we are making and we are converting those materials into finished goods, Once we convert those materials into finished goods, we then transfer that to the finished goods, and then once they're sold, they are expensed off on the income statement as cost of goods sold. So we're talking about balance sheet here, and so balance sheet, balance sheet, balance sheet, and then cost of goods sold. Where does that usually get expensed off? On the income statement. So these are balance sheet accounts, our materials, our work in process, and our finished goods. And then once those finished goods are sold, they are expensed off as cost of goods sold. So now in the work in process account, remember we've talked about a couple times here, we have direct materials. The value of any job or anything in work in process is going to involve three different types of costs: direct materials, direct labor, and allocated overhead. And so the allocated overhead, what we talked about, computing that predetermined rate for the year, and then as we incur that allocation base, whether it's machine hours or direct labor costs, we're going to allocate and spread out those overhead costs to the different jobs based on how much resources those jobs consume. Now, when we talk about tracking overhead and cost incurrence, we're going to talk about cost incurrence, and we're going to talk about the manufacturing, recording of the manufacturing overhead itself. Cost incurrence, remember we talked about direct costs are charged to a specific job in work in specific job and work in process. For example, direct materials will be assigned to the specific job. Direct labor, we can easily and feasibly trace that to a specific job and work in process. Now, costs that are not associated with direct materials or direct labor are charged or debited to the manufacturing overhead account. So, direct materials, direct labor are going to be charged or debited to work in process. For manufacturing overhead costs that we incur, we're going to charge or debit the manufacturing overhead control account. The respective accounts, like wages payable, utilities payable, taxes payable, accumulated depreciation, are recorded as credits in our journal entries. And we'll actually look at that here in just a moment. So now overhead cost allocation is the overhead is allocated or applied. In fact, you might see some people refer to as applied overhead because we're applying overhead to different jobs. But overhead is allocated to each job on the basis of the amount of the allocation base that is consumed or used up. And again, this reinforces the concept that different jobs are going to consume different amount of resources. So we want those jobs to consume a lot more of the resources to get a lot more of the overhead costs assigned to them. And then jobs that consume very little of those overhead resources will have a lot less overhead costs assigned to them. Now, when we allocate manufacturing overhead, now we talked about over here the costs that are actually incurred for manufacturing overhead. We're going to debit to manufacturing overhead. But when we allocate manufacturing overhead, we're going to debit work in process and credit manufacturing overhead allocated. And we'll talk a little here about that in just a second here. But both manufacturing overhead control and manufacturing overhead allocated accounts are temporary accounts. So we're going to need to, so these accounts will be closed at the end of the period when we adjust for overhead over or under allocation. And we'll talk about that in just a little bit also. So when we look at, now some companies will only use one account for dealing with the incurrence of or the allocation of overhead. Some companies will use two, and we're going to go with the assumption here that we're using two accounts. And so let me, and this is for overhead cost incurrence. And this is going to be the allocation of overhead. So whenever we incur costs associated with what? Indirect materials, indirect labor, plant utilities, plant taxes. Remember, manufacturing overhead costs are the costs of producing a product that are not direct materials or direct labor. And these can be varied, but these are associated with production of goods. Now, as we incur overhead costs, we're going to debit manufacturing overhead. As we allocate overhead, we're going to credit overhead allocation to work in process. So let's see. Let's see these from a journal entries point of view. Let's start from the very beginning. When we first purchase materials, what are we going to do? Well, we're going to debit our materials control account and credit accounts payable. Why are we debiting a materials control? Because, well, remember that materials is an asset, and assets have a debit balance. So when we buy more materials, we're going to debit our materials, and then we're going to credit accounts payable, because remember, accounts payable is a liability, and we're going to assume for our purposes that we're buying our materials on account or on credit, unless otherwise told. So when we purchase materials, we're going to debit materials control and credit accounts payable. Now, when I transfer materials to the production floor, I'm going to reduce the amount of materials I have and increase. So that's why I'm going to credit materials control, and I'm going to debit work in process inventory. And this is going to record the transfer of direct materials to work in process. So whenever I have direct materials, I'm going to debit work in process inventory and credit materials control. Now, when I incur direct labor, I'm also going to debit work in process inventory for the cost of my direct labor, and I'm going to credit wages payable to record the direct labor incurred. Now, let's take a look at overhead here. Let's say I incur some indirect labor, some machine depreciation. Let's see, you plant utilities and indirect materials. What am I going to do? As I incur those costs, I'm going to debit all my indirect costs as I incur them to the manufacturing overhead control account. And then I'm going to credit wages payable, accumulated depreciation, plant utilities payable, materials control. So I'm going to credit those respective accounts. But all those costs are going to be charged to or debited to the manufacturing overhead control account. Okay, so now let's take a look at when I allocate overhead. Now, when I allocate overhead, I am going to assign some of those overhead costs through the predetermined allocation rate process. I'm now going to actually assign some overhead to the cost of making those individual units of output by debiting work in process inventory and crediting manufacturing overhead. So when we look at, in fact, we looked at it before in a prior video. My work in process is going to have three accounts charged to it: direct materials, direct labor, and manufacturing overhead that's been allocated. So now, let's say that we complete some units and get them completed, and now we have the cost of goods manufactured. The cost of goods manufactured is not an account, but is simply a descriptive term to explain or describe the costs associated of those units being completed. So if they're completed, they're no longer work in process, but they're now finished goods. So then so the completed jobs to finished goods, we would debit finished goods inventory and then credit work in process inventory. And just as a thought, what are we really doing with transferring materials to work in process and then transferring work in process to finished goods? We're just moving things from one asset account to the next asset account as more costs are incurred and those units are completed. Once we start those units, we transfer them from materials to work in process. Once those units are completed, we transfer from the work in process inventory account to the finished goods inventory account. So we're really just transferring those costs from one asset account to another until until those jobs are sold. Then once we sell or some of our finished goods inventory, we're going to debit accounts receivable or cash for the amount that we're receiving, and then we're going to credit sales revenue to record the sale of finished goods. Now, as with merchandise inventory, if you remember from financial accounting and intermediate accounting, whenever we sell inventory, we're going to have a two-part transaction here. This part is going to record what? The revenue generated or associated with the sale of the product. We're going to record the revenue. But then we have the second part here. The second part of this is to remove those finished goods from inventory because we don't want to leave them in inventory if they're sold. And then we're going to expense them off as cost of goods sold. So once I sell something, I'm going to record the revenue here. And then the second journal entry is going to record the removal of inventory and then have it expensed off as cost of goods sold. So let's take an example here. Spooky Industries uses a predetermined overhead allocation rate based on direct labor costs. At the beginning of the year, it is estimated that manufacturing overhead rate to be 20% times the direct labor cost. In the month of June, Jordan completed Job 13C, and its details are as follows. There was $6,460 worth of direct materials. Direct labor costs were $21,000. Direct labor hours incurred 34, and units of product produced 210. So we're asked, what is the cost per unit of finished product for Job 13C? And we're told to round our answer to the nearest cent. So what do I have to remember first? The cost per unit, I need to get the total cost of making the product, and then I can take that total cost and divide it by the number of units produced in order to get my cost per unit. So I need my direct materials cost, $6,460. Actually, we got that right up here. Then my direct labor cost of $21,000. And then now I'm going to have what? What's the third cost I'm going to have in the making of anything? Overhead allocated. So how are we going to do that? Manufacturing overhead allocated? Well, remember our allocation rate is 20% times the direct labor cost. So whatever the direct labor cost is, we're going to take 20% of that and add that to the cost of direct labor and direct materials to account for manufacturing overhead. So when I take the $21,000 of direct labor costs, because that's my allocation base, because we've given in the problem here our overhead allocation rate based on direct labor costs. So I'm focusing on my direct labor costs, and the rate is 20% of that. So whatever this is, my direct labor costs, the overhead allocated is going to be 20% of that. So in this case, my total cost of making the product is how much? The whole cost of Job 13C is going to be $31,660. $6,460 of direct materials, $21,000 of direct labor, and $4,200 of manufacturing overhead. So my cost, the total cost for Job 13C is $31,660. Now, if I want to know the cost per finished unit, what am I going to do? Well, I'm going to take that total cost, and like I said, I'm going to divide that by the number of units produced. And in this case, units produced in job 13C is 210. So I take my 31,660, divide that by 210 units, and my cost per unit is going to be $150.76. So that's how I can compute the cost per unit there. Let's take a look at another example. And in this example, we're actually going to have two cost pools. So we're going to look at Hill Manufacturing. Hill Manufacturing uses departmental cost driver rates to apply manufacturing overhead to cost of products. Manufacturing overhead costs are applied on the basis of machine hours in the machining department and on the basis of direct labor hours in the assembly department. So before we go any further, what do we see here? Each department can have its own, is going to have its own overhead cost rate or overhead cost, and then each department can have a different allocation base. It's not going to be the same allocation. It may not be the same allocation base across all the departments. So now, at the beginning of 2018, the following estimates were provided for the year, and we have the estimates over here on the left side. So we estimated what? Manufacturing overhead costs of $250,000 in the machining department, $360,000 in the assembly department. And then we have our estimated direct labor hours, machine hours, and direct labor costs. Now we're asked to compute the manufacturing overhead rate for each department. And so we need, based on this, what do we have here? Now the machining indirect rate is going to be $2.50 per machine hour. How do we get that? Well, in the problem, we're told manufacturing overhead costs are applied on the basis of machine hours in the machining department. So I'm going to take my estimated overhead of $250,000, and my allocation base is machine hours. So how many machine hours do I expect to use next year? Well, I expect to use 100,000. So if I spread out those overhead costs of 250,000 over 100,000 machine hours, I'm going to get a rate of $2.50 per machine hour. So in the machine department, for every unit I produce, I'm also going to assign overhead of $2.50 per machine hour that it takes to make that product. But is the product going to be done just being in the machining department? No. It then goes to the assembly department. So how are we going to calculate overhead and add overhead in the assembly department? Well, in the problem, we're told that overhead is allocating the basis of direct labor hours in the assembly department. So I'm going to take my overhead, manufacturing overhead in the assembly department here, 360,000, and I'm going to spread that out over the number of direct labor hours I expect to incur next year. And next year I expect to incur 90,000 up here. So with 90,000, if I take that $360,000 of overhead costs for the assembly department, and I spread that out over 90,000 direct labor hours, then the overhead assigned to the product from the assembly department is going to be $4 per direct labor hour. Now, so each product is going to have two different applications of overhead in this example. We're going to have overhead from the machining department, and then added to that overhead from the assembly department, and together that's going to be my total overhead allocated. So let's compute the cost of job 846. The cost of job 846 is going to be the direct materials plus direct labor plus the total allocated overhead, and that's going to be the adding together of the overhead assigned from the machining department and the assembly department. So, and let's take a look here at job 846. How are we going to allocate overhead? Well, I'm giving the amount of direct materials cost of $4,300. How do I know that? Well, let's take a look here at the direct materials cost. $2,700 of the direct materials was incurred in the machining department, and then $1,600 additional direct material costs were incurred in the assembly department. So my direct materials are a total of $4,300. So that's my total direct materials cost. My direct labor costs are going to be the sum total of direct labor incurred in both departments as well. I incurred $400 of direct labor costs in the machining department, plus an additional $900 of direct labor costs in the assembly department. So my direct labor costs are $1,300. So far, I've got $4,300 worth of direct materials, $1,300 of direct labor. Now, I'm going to assign or allocate my overhead. Remember, we have two departments, so that we're going to allocate overhead on the basis of machining hours or machine hours in the machining department, and then on the basis of direct labor hours in the assembly department. So I'm going to take my cost rate, my overhead allocation rate, $2.50 per machine hour, and job 846 took how many machine hours in the machining department? Well, 170. So I'm going to take that $2.50 per machine hour, multiply that by the 170 machine hours incurred in the machining department for job 846, and that's going to give me part of my overhead. And I've got that right here. But are my products completed? No, they go to the assembly department. So in job 846, I'm going to allocate overhead on the basis of $4 per direct labor hour. So at $4 per direct labor hour, how many direct labor hours did I incur in the assembly department? Well, I incurred 120 direct labor hours. So $4 per direct labor hour times 120 direct labor hours. And so that'll give me the amount of overhead I'm going to allocate in the assembly department. So a total cost when I add these up and multiply these out and then add these all together, the job cost of job 846 is going to be $6,505. So, okay, so, and let's hold on just 1 second here. Okay, so our total cost of job 846, $6,505. Now, when we're dealing with when we use normal costing, we're assuming normal costing here. The overhead that's incurred is going to be different than the overhead allocated. Why? Well, when we allocate overhead, remember it's based on an estimated amount before the beginning of the year. With incurring costs are not always going to be the same way we predict it. Some costs are a little bit more than we anticipated, and some costs may be a little bit less. And we may end up incurring a lot more costs because maybe sales are up or additional things, or maybe the cost of, let's say, electricity goes up or what have you. So when using normal costing, there'll be a difference in the amount of overhead actually incurred and the amount of overhead that is allocated to jobs at the end of the reporting period. So now at the end of the year, remember we had those 2 T accounts, manufacturing overhead control account for the cost incurrence, and manufacturing overhead allocated for the allocation. When I combine the effects of these two, we have so they're related accounts. If I add up my costs, and let's say they're 500,000, and I add up my overhead allocated, and let's say there's 480,000. Well, in this case, an under allocation occurs because the actual overhead costs incurred are greater than the amount of overhead that's been allocated. So, as we incur those costs, we're going to keep watch of them. But at the end of the period, once all the overhead has been allocated, if we have more overhead that we actually incurred than what we have allocated, then we are under allocated, or this is an under allocation. And when under allocation occurs, this means the products produced have not had enough overhead allocated or assigned or allocated to them. So these products will be undercosted in a way, and so thus we will need to increase the amount of overhead assigned to those products. Now let's take a look at overhead or overallocation. In overallocation, this occurs when the actual overhead costs incurred are less than the amount of overhead that has been allocated. In other words, we've allocated more overhead costs than what we've actually incurred. And when this happens, this means that the products produced have too much overhead costs allocated to them, so we've overcosted them. And if we're overcosting them, then we're saying that these cost a lot more than what they really should. And so in order to do that, we're going to need to reduce the amount of overhead assigned to these products. So now there's three ways to deal with this over and under allocation issue. And the first one is the adjusted allocation rate. And this is a method by which overhead entries in the general and subsidiary ledgers are just restated by using actual cost rates. In other words, we use the predetermined overhead allocation rate for pricing and product mix decisions and so forth throughout the year. But at the end of the period or end of the year, we figure out our actual allocation, the actual amount of costs incurred, and the actual amount of the allocation base, and then we go back and restate all that overhead that's been allocated, and we use actual cost rates. The write-off the cost of goods sold. We can actually just close off the over or under allocation if it's material in nature, and we just simply adjust the cost of goods sold account. And then we have the proration where the under or over allocation is prorated between work in process, finished goods, and the cost of goods sold. So let's take a look at the closing out of it to closing at the cost of goods sold. In this example, in this first journal entry, this is for under allocation of overhead. So I'm going to close out and debit manufacturing overhead allocated for whatever the dollar amount is, cost of goods sold for whatever the dollar amount is, and then credit manufacturing overhead to adjust for the under allocation of overhead. What am I going to do with over allocation? Well, I'm still going to debit manufacturing overhead allocated. Now, why am I debiting that? Well, remember, our manufacturing overhead that's allocated has a credit balance. So in order to get that to a zero balance, I've got to debit it for the total amount that has been credited to date. I've got to debit that account in order to get it to a zero balance. And then the same thing with manufacturing overhead control. Remember, it has a debit balance. And then let's say manufacturing overhead control has $50,000 worth of actual overhead costs incurred. How am I going to get that to zero? Well, I would have to credit manufacturing overhead by $50,000 to get it to a zero balance. And then the difference between those two balances, the manufacturing overhead allocated, manufacturing overhead control account, the difference there is going to be charged to cost of goods sold and where we adjust for the over or under allocation. Now, if I'm going to prorate this, I'm going to prorate it between work in process, finished goods, and cost of goods sold. Now I can do this either with the unadjusted ending balances in work in process, finished goods, or cost of goods sold, or I can do this with the amount of manufacturing allocated in work in process, finished goods, and cost of goods sold. So for example, and let's just give an example here, and let me find this here. Let's say that I have my ending balance and work in process is what? $100. And my ending balance of finished goods is $200. And my cost of goods sold for the period is, let's see, $1,300. What is my total account balances between those? Well, my total account balance would be what? If I add all those account balances together, I would have 1,300 plus 200 plus 100 would give me 1,600. And so let's see here. So my total is 1,600 between all those three accounts. And then what percentage of that 1,600 does that 100 represent? Well, if I take 100 divided by 1,600, and we're going to say it's 6.25%. So 6.25%. And then let's see, what would that 200 represent? How much is 200 out of the total of 1,600? Well, if 100 is 6.25%, I'm going to assume that 200 is 12.50%. And then 1,300 would be what? Let's see. 81.25%. So now here's an example. And so I've got my percentages, so I'm going to prorate the amount of overhead or the amount of overhead that's been under or over allocated. And then I'm either going to subtract those or add that amount to work in process. So let's say that I have overhead that's been allocated let's just say my overhead, the difference between my overhead that's been incurred and allocated is 10,000. So let's see. Let me go up here, and I have under allocated 10,000. Now, what am I doing here? Well, what I'm doing is my total under allocation is 10,000. So based on these percentages, I'm going to assign 6.25% of this under allocation to work in process. I'm going to assign 12.5% of this under allocation to finished goods. And then the remaining 81.25% I'm going to assign to cost of goods sold. Now, if I'm under allocated, remember I don't have enough manufacturing overhead costs allocated to these products. So that's why I'm debiting this work in process, finished goods, and cost of goods sold, because I don't have enough overhead that's been allocated. And I need to add more. So those products are under costed. I need to bring those costs up to date or to bring it to where they need to be. So this is how you can see that. So in this case, let's say my ending balance is $100. I'm going to take what's 10,000 times 0.0625, and I need to add, based on this under allocation of 10,000, I'm going to add, so what do I have here? Would be what? 100 plus $625. So my new balance would be what in work in process would be what? $725. What about finished goods? Well, I have a balance of $200 in there, but I'm also under allocated by 10,000. So what I need to do, I need to increase that amount by so I'm going to take 12.5% of that 10,000, and how much will I get? 10,000 times 0.125, and that gives me $1,250. So what is the, and let's say, so my balances before adjusting was 200, added my prorated amount of 1,250, and I have what, 1,450. Then I have my cost of goods sold. My ending balance in that was what, 1,300. And then I'm going to assign this under allocation of 10,000 times a prorated amount of 81.25. Oops. 10,000 times 0.8125. 8,125. And so my new cost of goods sold account after the adjusting entry would be what? 9,400. $25. So that's the concept of the manufacturing overhead, that the prorated amount is prorated between work in process, finished goods, and the cost of goods sold. Now let me clear this off here. And then when I have over allocation, I'm going to credit work in process, finished goods, and cost of goods sold for the amount of the over allocated, that the prorated between the three. And why am I going to do that? Because I already have too much cost in there, and I need to reduce those costs. Now, let's take a look at job costing in the service sector. Job costing can be useful in the service sector in addition to the manufacturing sector. Where can we use job costing? Well, repair companies, contractors, tax professionals, restaurants, advertising agencies, printing companies, consulting services, legal services. All those are you're going to be charged based on the amount of resources that you use in the service. Not all, you're not going to pay, for example, you're not, you're getting your taxes done. If you just have a simple W-2, well, it's going to cost you a lot lower dollar amount wise than if you had a whole schedule C, D, E or F and so forth. So job costing in the service sector, we can use that too. In the service sector, we're providing a service, not manufacturing a product. Therefore, now while we won't have direct material costs, we will have costs associated with direct labor and overhead. Now, many times, overhead will be allocated to each job on the basis of direct labor hours, or sometimes billable hours in some situations. And in some instances, it may make sense to use budgeted cost rates for direct costs. We are budgeting, let's say, for example, we're doing taxes. Let's say if I know that for a returning client, it will take me, let's say, half an hour to get the information in there because they're a very simple return. So whatever that hour, I can budget cost rates for direct costs as well. We're not going to really get into that in this video, but in some situations, they may make sense. So let's take a look at job costing in the service sector. And let's take an example. Kindle Corporation applies manufacturing overhead costs to products at a budgeted indirect cost rate of $80 per direct manufacturing labor hour. Or actually per direct, and we should not say manufacturing labor hour. Why? Because we're not manufacturing. Per direct labor hour. A retail outlet has requested a bid on a special order of a necklace. Estimates in this order include direct materials, and actually, I guess we are manufacturing something, but so I guess this is not a service sector here, but we'll take a look here. It's still good. This is still a good illustration for job costing in those and when we're bidding on special orders. So I really should have here job costing and for special orders. So not in the service sector. So I apologize for that. So Canada Corporation applies manufacturing overhead costs to products at a budgeted indirect cost rate of $80 per hour of manufacturing labor hours. A retail outlet has requested a bid on a special order of necklace. Estimates for the special order include direct materials of $44,000, 300 direct manufacturing labor hours at $25 per hour, and a 20% markup rate on total manufacturing costs. What is the price and bid price for the special order? So when we're doing a special order, what do we have? We have total cost of direct materials plus direct labor plus manufacturing overhead. So we also when we're bidding on a job, we need to know two things here. What are the total costs of the job? And then how much are we going to mark it up so we know how much profit we have to cover other expenses associated with being in business, some of our period costs and so forth. So the first thing is I want to know my total costs. So my total cost is going to be direct materials of $44,000, direct labor of $25 per hour times the 300 labor hours incurred, plus manufacturing overhead of $80 per direct manufacturing labor hour times the 300 labor hours incurred. So my total costs are going to be $75,550. Now the next thing I need to compute is the total markup, or not the total markup, the markup component of the bid price. See, my bid price is going to be comprised of two parts: the cost and the markup component. So the markup component of the bid price is going to be my total costs multiplied by my markup rate. What is my markup rate? Well, we told in the problem here that we have a 20% markup rate on total manufacturing costs. So I'll take my total cost of $75,550, multiply that by 20%, and that will give me the amount of markup that I would want on top of my costs to come up with the bid price. So in this case, my markup component of my bid price is going to be $15,100. So now I want to look at my bid price is going to be my total cost plus my markup component. My total costs are what? 75,500 plus the markup component here we can compute just up here 15,100. My bid price I'm going to bid on the job is 90,600. Now I may not get the job, but that's going to be the price I make a bid at, and then I may make some adjustments, for other factors, but this is going to be probably the price I'm going to bid if I want to have a consistent markup um, uh, when I'm trying to make money. I want that markup. So okay, and that is the end of this session. If you have any questions, please feel free to email me. I'll be more than happy to respond.